Hi, Bengal. You.
Hi, Shiran, can you hear me? Am I audible?
Yes, yes, great. All right.
Hmm?
Yanko, Wango, let's go! Yanko, Wango, let's go! Hush!
I want to play it smart.
Yanko, Wango, let's go!
A brand new start.
Yanko, Wango, let's go! Hush!
I want to fly.
Yanko, Wango, let's go!
Give great a try.
Live your best life every day with the Smart Network. Hutch, go smart.
Yanko, Wango, let's go! Yanko, Wango, let's go! Hush!
I want to play it smart.
Yanko, Wango, let's go!
A brand new start.
Yanko, Wango, let's go! Hush!
I want to fly.
Yanko, Wango, let's go!
Give great a try.
Live your best life every day with the Smart Network. Hutch, go smart.
Yanko, Wango, let's go! Yanko, Wango, let's go! Hush!
I want to play it smart.
Yanko, Wango, let's go!
A brand new start.
Yanko, Wango, let's go! Hush!
I want to fly.
Yanko, Wango, let's go!
Give great a try.
Live your best life every day with the Smart Network. Hutch, go smart.
Russia.
Good afternoon, everyone. Welcome to the webinar Economic Outlook 2022 conducted by the Chamber Academy of the Ceylon Chamber of Commerce. On the onset, I would like to thank our corporate sponsors, Hutchington Telecommunication Lanka Private Limited and London Stock Exchange Group Sri Lanka. Without further ado, I would inform everyone of the house rules. Kindly switch off your cameras and mute your microphones. Only the speakers will use their cameras and microphones for the presentation and dialogue. Questions from the participants will only be taken through the chat box. A recording of the session will be shared on the conclusion of the session. I would like to remind everyone of the agenda of today's webinar. Mr. Manjula De Silva, the CEO and the Secretary General of the Ceylon Chamber of Commerce, will give the opening remarks. The keynote by Dr. Kenneth De Silva, Chairman, Financial System Stability Consultative Committee of the Central Bank of Sri Lanka, which will be followed by the presentation of the Outlook 2022 report and the launch of report by Mr. Shiran Fernando, the Chief Economist of the Ceylon Chamber of Commerce, followed by the panel discussion. I now welcome Mr. Manjula De Silva, the CEO and the Secretary General of the Ceylon Chamber of Commerce, to make the welcome remarks. Over to you, Mr. Manjula.
Thank you. Dr. Kenneth De Silva, Chairman of the Financial System Stability Consultative Committee, who will be our keynote speaker today. Other panelists and participants, warm welcome to all of you to this webinar on Economic Outlook 2022, which is organized by the Ceylon Chamber of Commerce to mark the launch of the Economic Outlook 2022 report that has been prepared by the Economic Intelligence Unit, which is known as the EIU of the Ceylon Chamber. This is the 7th time this report has been compiled, and it has now become, the launch of this report has now become a key feature in the annual calendar of the Ceylon Chamber, typically held in the month of February. Earlier, we used to launch this at a physical event or a seminar, and up to 2020, I recall in 2020, we had Professor W.D. Lakshman, the governor of the central bank at that time, as the keynote speaker. But in 2021, we had to switch to a virtual format due to the COVID pandemic. And this year also, we are compelled to stay with a virtual format. But I don't think that would be an issue, because I can see already quite a few have logged in and the number is growing. So we are expecting a significant number of participants to join today's event. So let me give a brief introduction to Dr. Kenneth De Silva, who actually doesn't need much of an introduction to this kind of an audience, but just briefly, Dr. Kenneth De Silva is a top economist and a senior banker. He's currently the chairman of the Financial System Stability Consultative Committee of the Central Bank of Sri Lanka, and is also at the same time the 5th chairman of Lanka Clear. And Dr. De Silva counts over 20 years of experience in banking, managing business at senior managerial levels across all verticals. He's an expert in treasury, especially in the areas of risk management, money markets and debt markets in both domestic and international financial markets alike. This is very interesting that he was a part of the global advisory team for government of Sri Lanka, the US dollar bond issuance, and worked closely with the senior officials of the central bank in drafting guidelines for the market during his tenure at HSBC. So he's someone who's very conversant on that subject. Dr. De Silva was also the president of the Sri Lanka Forex Association and has been instrumental in setting up the ACI Market Ethics Committee, the Education Committee, and a regulatory framework, inspiring and leading the association to new heights. Under his leadership, Dr. De Silva was able to gain Sri Lanka Forex the full membership of ACI International and make the association internationally reputed. He was appointed secretary for the ACI Model Code Committee by Central Bank and was responsible for Sri Lanka's first interest rate option and currency derivative transactions in Sri Lanka. He also developed the first Islamic finance rupee bond, which is called Sukuk. A veteran in business cycles and real economy, Dr. De Silva holds a PhD, MA in economics, and a postgraduate diploma development economics from the University of Colombo. He also holds an MA in economics for development from the Erasmus University of Rotterdam, Netherlands, apart from the postgraduate diploma in bank management and finance from the Institute of Bankers, Sri Lanka. He has contributed to many papers in reputed journals, including the anniversary edition of the Association of Professional Bankers. So we are very happy to have you here, Dr. Kenneth De Silva. I think speaking at a chamber forum probably for the first time in recent years. So we are very, very pleased to have you at this forum. Let me also quickly welcome the other members of the panel who will be later joining the panel discussion. So we have Mr. Bigumal Tevaratantri, CEO, Standard Chartered Bank, Ms. Haja Alafifi, Chairperson of Unilever Sri Lanka, Dr. Roshan Pereira, Senior Research Fellow, Advocata Institute, and Mr. Vinod Hydramani, Director, Hydramani Group. So we have a very eminent panel also who will be participating in the panel discussion, which I will moderate later on. So as explained, the program will first share the keynote address by Dr. Kenneth De Silva, followed by the presentation on the Outlook report by Shiran, after which we will have the panel discussion. So with that, I will now invite Dr. Kenneth De Silva to make his keynote address. Over to you.
Thank you, Manjula. Thank you for those warm words and extensive focus on my capital markets career. Yes, I was there in 2008 when the first bond was being floated in Sri Lanka. At that time, just during the war. And I can remember those memories very well and how we tried to present the bond. So thanks for reminding me and refreshing my mind of this particular transaction. So let me quickly shift into my.
Dr. Kenneth, you're going on mute.
You got muted, Dr.
Sorry. Sorry. So okay, I was just telling thank you to Manjula for his kind words and his warm welcome and his recollection of my participation of the bond back in 2008 when I was at HSBC. It was the first time I think Sri Lanka tapped the capital markets, and thank you for bringing that up. It's a very warm memory of the past. So thanks for that. Thanks for introduction. Thank you everyone for having me on this forum. It's a pleasure to be here. I was initially spoken to by your chairman, I think, Vish Govindasamy, who approached me and said, Kenneth, why don't you get on this and tell us what your thoughts are? So I was kind enough to oblige on this particular request, and here I am. So warm welcome to everyone. Good evening to you all, good afternoon and good evening to you all from wherever you may be viewing this particular program. Let me quickly get into my presentation mode, and then we can go through the key areas of my presentation, which I will share right now. Right. So I thought I will talk to you today about this particular topic, which is very close to my heart because I come from the banking and finance sector. And I think profits play a key part in the overall economy. And I thought it is best to dwell on this and look at the so many discussion points that are out there on Sri Lanka's economy. I know I feel at times cornered by the many questions that come about because there are so many eminent economists out there who seem to predict that we will fail and we will not prosper. There is the saying that economists and weather forecasters are almost the same because they can never get it right. And I think I allude to that because I've seen so many economists out there who have predicted our failure. And here we are today still discussing the future and also looking at what plans and what plans are in place for the future ahead. And it gives me some comfort to present this because I know, like I told you before, people who forecast the weather also get it wrong. So I think if I get this wrong, it doesn't really matter. But nevertheless, let me quickly move into the next slide. I think it's important to put into context what we're trying to do because it's important to look at these particular areas. I look at Sri Lanka purely from a balance sheet point of view because I think a member of the panel who sits on this webinar today, Bigumal is also from Standard Chartered. He probably will relate to this more closely than many of the economists out there. So I look at Sri Lanka's balance sheet and I look at it from a cash flow point of view, and then I make my decisions in terms of whether Sri Lanka is doing well or doing bad. And I think it's important for us to start focusing on this particular aspect because the economic journey that we have seen so far and the economics that we have seen thus far has not been able to forecast or predict or give us some color in terms of what is going on with the Sri Lanka economy, not only the Sri Lankan economy, but the overall global economy. So the global economy plays a pivotal part in the overall trajectory of the local economy. Many seem to ignore that and decouple it. I think there is no form of decoupling that can take place. We are an integral part of this global economy. Globalization is here to stay. And therefore, it is important for us to put it into context and understand where Sri Lanka is in the overall business cycle and how best we can make use of this business cycle and refocus and recalibrate our economy to capture the economics of market share. I think the economics of market share is a paramount focus in Sri Lanka's future growth plans. And I think we need to look at it because Sri Lanka's balance sheet is underutilized. And that's my final point where we try to look at a 5x or a growth multiple of 5 times our balance sheet. And how do we get there? And what do we need to do? So those are the key points I'm going to kind of talk to you today. And let me go into the next slide to give you a bit of a snapshot of what we have achieved thus far. Now, if you look at our history and our economic history, nothing great to really talk about. I mean, we've been talking about this for years. We have had only 6 instances where we have recorded a 7+ growth rate, GDP growth rate, 7 instances in our history. Nothing really significant. We have been comparing ourselves to many other East Asian economies, and yet we're talking, and yet we're doing nothing, right? We have averaged about 4.7 GDP growth over the 44 years. We have inherited a balance sheet with debt which has oscillated between a high of 104%, and we are slowly crawling back up there with an average of about 89%. So you can see debt has been part and parcel of our journey thus far, and also fiscal deficit of about 7.5% thus far. We have had highest fiscal deficits in many years, but all in all, we are boxed on. Sri Lanka has not failed. Sri Lanka has progressed. People are happy, maybe not 100%, but people are generally happy. So what's going on in the Sri Lankan economy? How do we change this, or do we want to change this? Do we want to achieve a continuous 7 to 8% growth that we have been talking about for years and comparing ourselves for years on the likes like China, Singapore, and some of the Southeast Asian countries like South Korea? We compare ourselves to many countries, South Korea being one. So what exactly is going on? Now, before that, Sri Lanka, before we go into the nuts and bolts of how we get to this and how we address this, which is in my third point of the presentation, we have to look at what is going on in the world today. And what we are seeing is basically the world has gone through 5 shocks. One shock is the global health shock. The second shock is the global travel restrictions, which has impacted Sri Lanka significantly. Thirdly, we have seen global commodity prices at unbelievable levels. In fact, they're talking more of commodity price surges and inflationary buildup. Fourthly, we have seen unbelievable freight cost increases, not only the Baltic Dry Freight Index, but also the Southeast Asian Freight Index. Also, we have seen significant surges. There seems to be no real respite in that, coming down. So we are saddled with that. And finally, we have our overall dollar liquidity concern, which is now taking place globally, and central banks are trying to address that. So with these types of challenges, Sri Lanka entered its economy in 2000. And if you look at it back in the day, Sri Lanka's economy, from a balance sheet point of view, the real sector, you can see how Sri Lanka's economy fared, and particularly the last 5 years, what really took place. We faced a significant rise in our domestic debt to equity ratios. This debt to equity ratios prompted a shift in the overall economic thinking. Do we continue our fiscal austerity measures as proposed by many of the economists and some of the businessmen out there who continue to say that, look, you should have never touched the fiscal side and never given a fiscal stimuli. And as a result of this fiscal stimuli, we are currently facing what we are facing now. So I just thought I'll give you a snapshot of why this fiscal stimuli was so important, why you couldn't continue that fiscal consolidation path, given the fact that Sri Lanka was coming into a situation where Sri Lanka's balance sheets, corporate balance sheets across the listed companies, if you looked at it, we looked at all listed companies, and you took a snapshot of this. This is a mere snapshot. And we looked at their overall performance. And you could see that their overall debt to equity ratios were rising. It continued to rise. Now, as the debt to equity ratios rise, the capacity for more borrowing is limited. So however much you give a monetary stimulus, that doesn't really work well. And that was captured by none other than Richard Koo, who analyzed the Japanese business cycle, and he analyzed the Japanese balance sheet recession that took place for 20 years. So Sri Lanka was coming into a situation where, not exactly like the Japanese, but almost similar in terms of the overall dynamics that were governing the real sector. So if we did move into that tightening type of environment, the Sri Lankan economy would have collapsed. There was no doubt in our minds that looking at a cross-sectional behavior, you could see that the balance sheet ratios were really increasing and earnings were depleting as a result of your overall contraction in the revenue side, which is your GDP. Your top line revenue is your GDP. So as GDP declines, your balance sheet debt remains constant, your debt servicing becomes an issue, and that debt servicing ultimately falls on the lap of people like Bigumal, who are managing banks' balance sheets. And you can see this in the balance sheets of banks. Balance sheets of banks, you can see the non-performing loans to capital as well as to their asset book increasing. And this we see increased right throughout from 2000, it gradually built up from 17 right up to 2019, and which was not healthy, which means that banks had to tighten their overall credit policy, had to rein in on credit, had to now focus on recoveries, and that recovery process is a costly and tedious process for banks and for the economic participants who are the real sector borrowers themselves. So therefore, the policy shift was to ensure that we not use monetary policy as seen in the global space, as seen in global, we call this taper tantrums. But in Sri Lanka, we don't have the luxury of buying bonds, corporate bonds. So in many of the developed countries, corporate bonds are issued, and therefore when the earnings start to deplete, the price of the corporate bond falls and the yield starts increasing, and therefore the debt serviceability of this debt becomes impossible for corporates. So what did the Federal Reserve and the central banks of the West do? They went out and they did a dual whammy kind of an injection where they went and bought out corporate bonds and they injected liquidity. Now, when you buy the corporate bond, you know the price of the bond will increase and yields contract. And therefore, the long-term yield curve tends to flatten out. With the flattening out, corporates can go back into the market and start reissuing bonds, recapitalizing some of these bonds, restructuring their bonds, and looking at how to manage their earnings in a declining business cycle. This is not possible for Sri Lanka. Therefore, instead of going the monetary route, you had to take the fiscal route. And the fiscal route was how best we can give some fiscal incentive to turn the corporate balance sheets out from danger and bring them back into some level of neutrality, and then see how we can increase their overall balance sheet exposure. And that is visible in the banking sector, as you can see from the liquidity ratios as well. Liquidity ratios, when there is a time of uncertainty, the overall liquid asset ratios tend to rise. And when there is economic prosperity, bank releases its financial assets and gets into the more real sector asset base. And that's what we are seeing in these two graphs. So that's an important departure from the overall economic thinking. I think policy makers looked at what we were trying to tell them. They realized the facts behind this. They realized that modern times require unconventional economic thinking because we have used economic thinking for the last 44 years and it has not served us well. If you look at the previous growth rates above 7%, only in 1969 we had above 7%, 1973 was the next, and then 2005 to 2014 was the next 4 periods that we found above 7% growth. So it shows that whatever we have been doing in the past had not worked. And therefore, a new policy approach had to be institutionalized. And that policy approach was institutionalized. And therefore, the companies that were suffering and their earnings depleting recorded significant gains. And you can see that in the stock exchange where they reported the highest ever earnings. And as a result of that, banks also found some ease from their capital constraints. As a capital adequacy was at a point where banks had to recapitalize with the high NPLs that were coming on their books. And therefore, in an environment where we were placed, that type of financing was not possible. So all in all, we have seen a departure from this. And now we are looking at the overall capital formation. You can see the headline revenue number, which is a GDP, declining from 2014 right down to 2020. 2020 was an aberration, a global aberration, not only focused on Sri Lanka. Global economy had an unusual downturn. Generally, you find this as part of an overall larger business cycle, but we saw this re-emerging in the business cycle, and this was somewhat expected, but it was in a different way. It was presented to the global economy. Generally, at the end of a business cycle, we find business cycle rebalancing taking place by wars. But in this instance, it was a health war that was fought. So it was partly expected and not a real surprise. We were expecting the global economy to contract. And we still see fragility in this global economy, even though Sri Lanka has still moved out from danger and recorded a 4.5% growth in 2020. I think there is a sense of optimism that can be looked from this particular trajectory. And we hope this optimism or this base can be built upon and we can really move into a 7+% growth as we spoke about earlier. Now, to do that, we need to understand what's going on in the world. And what's going on in the world, I think many of us who do have the luxury and the patience to watch Bloomberg during our free time and during office time with the permission of the bosses who are working, I think we'll find this particular language resonating as it's used very frequently in the Bloomberg news by all CEOs. And all CEOs are now talking about the next big move. The next big move, as I spoke to you earlier, is what we call in business cycle language, a long business cycle. We have smaller business cycles, which is a jugular business cycle, which we went through in 2015 and to 2019 as part of the overall correction. And now we are in a phase where we can see the global business cycle unearthing in front of us. And it's for the first time in a long period of each of our lives that we will see the unfolding of the long business cycle. The long business cycle is driven purely by technological change, as I've showed in this slide. We have seen the long business cycle move from the science revolution, the science and technology revolution, to the next revolution, which is AI, green technology, ICT, and agro-tech. So Sri Lanka is now in this particular dimension of its growth, plus the global business cycle. And the good news is that this long business cycle is driven by Asia. So the time for the shift from Westernization to Asianization is at hand. And if we don't do this, Sri Lanka is going to miss out on a monumental opportunity. And I fear that the most, because Sri Lanka businesses are still not reoriented to the Asian markets. I mean, if you look at the numbers, it's quite evident. Sri Lanka is still a trade partners, even though from the import point of view, our largest importers are China and India and somewhat Singapore. Our export basket is not really reoriented towards the Asian palette. So that's something which is of a significant danger, and we need to really rethink our strategy in terms of how we want to capture the Asian markets. And I will put this map up because it was an interesting map that I found on Moody's, who had also paid attention to the global business cycle and color-coded the global map in terms of what is going on in the business cycle. This you can easily download, and you can, it's an interactive map, so you can get on to this map and check what they say about each country. But in a sense, you can see the green is countries that are already in expansion mode, and the blue, the slightly darker blue is are countries that are in corrective mode or recovery mode. So which means that the global economy is now recovering, and you can see the shift and the rapid move of Asia, in particular Asia Pacific, but I would like to say Asia, recovering. Now, what do we do for Sri Lanka? So Asia, as you know, is a huge market. I don't know that many of you have looked at the numbers. Asia has about 50% of the world population, and it will continue to be so by 2050. Asia also accounts for about 7,000 per capita currently, and by 2050, that number will reach a staggering 40,000 per capita. Asia currently accounts for about 30 trillion of total GDP. By 2050, this number will be 174 trillion. So the numbers are staggering. And when you look at those numbers, you see how well China has positioned itself. If you look at what China did in the last 13 years from where they were, and you look at their growth in reserves, in fact, they doubled their reserves from 1.5 trillion to 3 trillion in a short period of 13 years. Now, this particular model speaks well of what is happening in the global economic sphere. I think the focus from economics has been predominantly restrictive and looking at old theories. These old theories need to now be put aside. We have confined ourselves to economies of scale. But if you look at economies of scale, it's not internal. Economies of scale have to be externalized, because we live in a vast market, a global economy. While saying that we live in a global economy, we are doing nothing about it. Right? We are still talking about comparative advantage. We are still talking about free markets. We are still looking at less state intervention. But all these theories are, if you look at it, redundant. Free markets are there, but they coexist with state intervention. I mean, if you look at what Singapore does, is a classic case, or what Germany does. Germany, there is huge state support. So do we find in Singapore? Similarly, we find in China, right? And these models have been successful for the simple reason that the state can take balance sheet risk onto their balance sheet as opposed to shareholder risk. If you look at our banks, our development banks are predominantly in consumer markets. 90% of our bank lending is consumer lending, short term, up to 1.5 years. Now, how can a country develop when your asset creation is more than 5 years? If you have to put up a plant, Vinod will agree to my statement saying that it takes at least 2 years to put up a plant. It will take more than 2.5 years to recover the capital in investment. But can a hydromoney group go and do this? Are the banks willing to lend? They don't, because our monetary policy is so unpredictable. Our fiscal policy is so unpredictable. So how can you bring in a profit story when we have unpredictable monetary policy and fiscal policy? And economists have to take the blame, because we talk to policymakers and we tell them what to do, and these policymakers rely on our advice. So therefore, the profit story disappears. And we look at only productivity, and labor productivity is just 10% of your total overall cost. Do we look at interest rate cost? Do we look at input cost? Do we look at price management for our transport, our energy? We don't. And then we want to get a 7% growth. If we can't manage our cost structure in this new business model, our cost structure is a key component. If we can't manage our cost structure well, we can't be competitive. And competitiveness is more important than comparative advantage. Comparative advantage doesn't exist. It's there in theory, and there is a lot of theoretical debates around this. I urge you to read this. I urge you to look at free market doctrine, where people like Stiglitz have criticized it. We have used it in vain. We have gone and opened up a market since 1977. There is good and bad. I'm not saying it's all bad, but we have opened it too fast, too soon, without any product capability. And as a result of the lack of products, we can't go global because we don't have global products. That's why we don't have global brands, because we don't have global products. We have multiple products here, but they are all localized. So we find our local entrepreneurs also become local. We find our banks who are international banks who come with international exposure also becoming local. We find our mindset also becoming local, and therefore we are localized as opposed to becoming globalized. So how can we compete? We simply can't. We simply don't manage our risk well, as I told you earlier, but we have it on our annual reports. How many of you all look at your annual reports and see the area where you all are supposed to have a risk management committee looking at the balance sheet risks of those companies? And how many of you all manage this balance sheet risk actively and dynamically and look at its impact on your P&L and your income statement? If we are doing that actively, we wouldn't have had to have pass-through cost. Because I was in Dubai and I spoke to many of the Dubai food producers, and they were absorbing it into their P&L and taking it onto their balance sheet while managing their cost more dynamically through an off-balance sheet mechanism. And that off-balance sheet mechanism is available to the Sri Lankan business community. People like Hydramani who are on the call, Anil Hydramani is here, Akhil Hydramani, sorry, who is here, and Bigu Mal, who is also here, know this. They know that there are guidelines issued by central bank permitting risk management of these companies, but we don't do anything. We watch the global business cycle go by, and we missed out on that opportunity when the global business cycle contracted and crude oil and all the global raw material prices dipped to its all-time low. We watched that ship sail. And then we want price control taken away because we don't manage our balance sheet risk well. And then we come to the government saying the government is to be blamed by keeping price controls. But if we do it on our own accord, then we don't need the government, because less government is what we require. We want the government to be an enabler and a facilitator. And while the government can be there in certain areas, government has to let go certain ventures that are not profitable and depart from these non-profitable ventures. But for that to happen, the private sector also needs to be actively engaged to create this new profit story, to look at how we can rationalize our balance sheet. I think that is so important now. The rationalization took place as a result of COVID, but the rationalization is not deep enough because Sri Lanka has a chronic trade imbalance, of about $10 billion, which is financed through borrowing. And the party continues. It has to be financed either through domestic borrowing or through capital markets borrowing. And as a result of that particular trade deficit, we have to engage global capital markets to tap into those markets to raise the required shortfall to fund this gap. And a result of that, we find that Sri Lanka is now in a situation where it has a dollar liquidity issue, which is coming at a huge cost. But all in all, I think what we need to look at is this new opportunity that has been created by COVID itself. How do we manage our imports more profitably? How can we internalize our savings? I think there are some great examples out there. We are seeing some great success stories and a new business model emerging in the fisheries sector. We have seen fisheries sector now becoming a surplus sector, which with a surplus of about $250 million registered last year. I think that success story is good. We have seen apparel industry with all the difficulties still stand out, but that's not enough for the apparel industry. That journey is not sufficient because that journey can't be a $5 billion journey. That journey has to be a $15 billion to $20 billion journey in the next 6 to 7 years, because we are currently if you look at the overall apparel pyramid, we are only at the higher end of the apparel pyramid. The apparel sector, global sector, is about $2.1 trillion. The middle market, we are not represented, and the bottom of the pyramid, we are not doing anything. So the apparel industry needs to relook at its corporate plan and its vision for the country, and look at how best it can internalize some of its earnings, particularly since the last budget, there was a emphasis on how best we can bring raw materials needed for the apparel industry into Sri Lanka by setting up apparel parks, and also looking at the mills that are required for one of the raw materials, which is fabric. The fabric parks are now taking place. So this is a good sign where we can at least then internalize about $2.5 to $3 billion worth of earnings. Only through this process can we restructure the country's balance sheet. Only by looking at what we can produce here in Sri Lanka using technology, right, to expand our capacity and managing those inputs well, can we internalize our savings. Only through that process can we restructure the national balance sheet. And by that, we can look at how best we can gather global market share. So the economics of market share is very important. As I told you, Asia is a rising destination for consumer tastes, for consumer goods, because there is a savvy Asian consumer that is coming about. In fact, if you look at CNBC's poll, about 1/3 of the global billionaires are in Asia. About 831 global billionaires come from Asia, and we have not really done too much. So I think it's time for us to really dig deep and ask some strong questions as to how we can restructure the overall national balance sheet and how we can turn Sri Lanka to become a profit story. Because without profits, there is no journey. Without profits, there is no balance sheet that can be sustained at this level. Without profits, you can't have a capital formation of 30 to 40%. And without profits, you can't look at doing any kind of modern technological innovation, because these are capital intense investments. And for that, you need to have people looking at how best you can internalize our domestic savings. So to cut a long story short, I think Sri Lanka needs to revisit its overall profit story and break away from this, we are too small type of mindset, right? Because we say, oh, Sri Lanka is a small country, 20 million, 21 million population. So economic scales are not there in our favor. And we build this overall structure that says that Sri Lanka can't, right? But if you look at Belgium, there are some great examples out there. If you look at some of the smaller countries out there, Belgium and Netherlands stand out in my particular findings. I mean, if you look at Belgium, they are maybe the top chocolate producing country in the world, right? They don't have any raw materials. They don't have dairy. They don't have cocoa beans. They don't have sugar, but yet they produce the world's best ice cream and chocolate. I mean, if you look at where they were in the 1960s, Belgium started off with a 1,275 per capita income. Today, they are almost 30,000 per capita. So Sri Lanka can learn from this, right? If you look at Netherlands, similar. Netherlands has a smaller landmass than Sri Lanka, a smaller population than Sri Lanka, but yet they export 100 billion euro worth of fruits and vegetables. They are the second largest exporter of fruits and vegetables in the world, next to the US. What's stopping Sri Lanka from becoming such a country? It is our own inhibitions. It is our own confinements. It is our lack of focus. It is our lack of finance. It is a lack of risk-taking. We talk about entrepreneurship, but how many of us support entrepreneurship? How many banks lend to entrepreneurs? We have some great products, but at a very local scale. We can't get them global. We can't make them globally competitive because we are not looking, as I told you, at those cost structures. We are not looking at the inputs. We are not looking at the business model. We are not looking at the revenue model. And as a result, we are trapped. And therefore, we need to break away from this if we are to reach and if we are to tap into this juggernaut that is taking place right in front of us. And Asia is going to be the next century of growth, right? It's happening after 300 years. And I think it's time that we looked at our profit story seriously and work towards moving from Westernization to Asianization and look at the product suite that is required by the growing Asian consumer market. We have still not done sufficiently enough. I was talking to some Chinese investors, and they were saying that they can't get a continuous order book done from Sri Lanka because we don't have the necessary production capacity. We have not paid attention to this, right? So we will miss out on that cycle because market share doesn't wait. If we continue to look at old economic theories, we will miss out on this market share, right? We need to have new thinking. And I think that new thinking is prevalent in places like China, who are running significant fiscal deficits even now. And fiscal deficits is not bad, provided it's put into production. But we have a notion that fiscal deficits are bad. Even though we have been running fiscal deficit for the last 40 odd years, we still continue to say fiscal deficits are bad. Fiscal deficits are bad if it's primarily used to consume goods that we don't produce. And as a result of that, we create a huge imbalance in our trade account and in our current account, and therefore we have to fund it. So this type of thinking needs to change. We need to look at working with the state and letting the state put out fixed capital assets, increasing its capital formation to about 6% of GDP. And if you look at our capital formation as a percentage of GDP has seen probably two blips about 25%, which one was in the early 1980s, late 80s and 90s during the industrialization drive during the Premadasa era. And the second we have seen is in 2010, where we saw post-war recovery shoot our overall capital formation ratio to about 28-29%. So this is the type of story we need to work on to ensure that corporate balance sheets are strengthened, profits are reinvested in the country, the profit story is capitalized, and use that profits for the betterment of the Sri Lankan economy, and to be focused on how best we can manage our risks and ensure that we take the opportunities when the opportunity provides us. But we have missed out on several occasions, and I think it's sad to see that we have missed out on a when the global collapse took place, that we couldn't enter into any forward contract or any form of derivative, because the term risk management and hedge has been misinterpreted. Bigumal, who was there, who was not there probably during the hedge, probably needs to look at this, and people involved in the chartered accountancy sphere, as well as bankers, need to re-examine what went wrong as a result of the hedge, because of that particular bad news that was publicized and really not given the real true insight as to what went wrong. Many Sri Lankan banks as well as corporates don't venture into risk management as a result of that. They don't want to touch it. But as a result of that, we are losing the opportunity to have low input cost, to manage our price risk better. So we need to look at this. We need people to be more proactive and be more responsible. We need the bankers, we need the accountants, we need the economists to examine the hedge that went wrong and see what went wrong and correct that and ensure that price risk management is undertaken. If you look at what Unilever is doing, they're in multiple geographies. They have got multiple balance sheet risk. They don't change their prices every week due to global price volatility. How many products do Unilever produce globally? Right? They are yet competitive. They are yet profitable. So I think there are lessons from such corporates. I think the corporates, such multinational corporates, have also a responsibility to look at shifting some of their business opportunities into Sri Lanka and using Sri Lanka's central location as a key logistics center to ensure that they are quick to market and also have low cost of freight as a result of this location. And that would enable Sri Lanka also to look at picking up some of the overall shifts that are taking place as a result of the global business cycle that's happening in China, where Sri Lanka can venture into strategic partnerships and JVs with these companies and bring in manufacturing and technology into Sri Lanka, because Sri Lanka has missed out on industrializing its economy. You cannot achieve 8% growth if you don't industrialize. And industrialization is not bad. It's not dirty as presented previously. Industrialization can be made clean with new technology. So we need to look at this very focusedly and very earnestly and try to see how best we can capture the global industrialization journey. So with this, I want to stop here. I'd like to thank the Chamber for inviting me and give me the opportunity to present this. I wish the rest of the deliberations success, and I thank all the panel members as well. And I thank again Wish for his invitation. Thank you and best of luck.
Thank you, Dr. Kenneth, for your keynote, and I think highlighting the profit story and a different view of examining the economy, and I think giving a lot of advice to the private sector. So thank you so much. If you can stop sharing screen, that would be great. Yeah. Thanks. So with that, I will move to presenting the Outlook presentation based on the report that is to be published by the Ceylon Chamber of Commerce by the EIU, as Manjula mentioned at the start. So we are also looking at the outlook in terms of the theme of road to recovery, overcoming challenges, which I will get into. Dr. Kenneth alluded to economics being a very difficult thing to forecast, and this year in particular is quite difficult in that sense. And we're looking at it in terms of 5 different themes that will likely play out. And I'll go through each of these in detail, but more details can be found in the report. So really the themes are in terms of growth. As Dr. Kenneth alluded to, how do we get back to 5, 6, or even 7% level of growth? What we're right now seeing is growth could come back to the pre-pandemic levels. Inflation has become a concern, not domestically as well, but also globally as well. How do businesses react in this environment? As a result of that, we're seeing also high levels of interest rates as well. Can we see interest rates much higher than what we've seen in the past in Sri Lanka's context? The FX uncertainty and the dollar liquidity concerns, are they expected to continue? And of course, the global risks. The last few years really dominated by the pandemic, but now there does seem to be other factors coming in as well. So just moving into the first theme really on in terms of growth, we've really seen post the initial impact of the pandemic in 2020, economic growth has recovered somewhat. Of course, the third quarter did see a bit of a slowdown, but overall economic activity seems to be getting back to what it was pre-pandemic. So the concern is really, will it get stuck at the 2 to 3% levels that we saw in 2018-19, or will we see it going back to the 4-5% and beyond? And what has really driven the recovery, a lot of the fiscal support, some of those measures, some of the other COVID-related measures that the government and policymakers provided has really supported what we call the household consumption level of GDP. And we can see in this recovery, particularly in the first 9 months, how much household consumption has grown in. So will this consumption story be sustained in the next few quarters in 2022? Or if we do see a slowdown in this, will it drag overall growth? But can investments or even the net exports side of it, can that be one of the key growth drivers going forward? So in terms of 2021, a lot of the forecasters are seeing growth under 4%, between about 3.3 to 3.6. We feel it'll close to about 3.8%. For 2020, however, there does seem to be a little bit of even a further downward revision by most forecasters, going back to what we call the pre-pandemic growth that we saw in 2018 and 19. And I think our expectation also is around about a 3% growth really because of the consumption slowdown that we would expect. And this is really important from a regional context as well, because our regional peers are recovering. They're growing. Particular markets like Bangladesh and India, and some of the others, which predominantly in the past has slowed down, are also showing signs of recovery. So the growth story is really more important, even from a regional dynamic perspective. Moving into the second theme of inflation, we've saw in 2021 really inflation picking up mainly because of food prices and some of the supply shocks that came with it. But in the last 3 to 6 months, we've really seen with some of the price controls removed, and of course, global oil prices and commodity prices going up, that being passed through as well, and inflation now getting back to double-digit levels, something we've not seen in about 12 years. So the question here would be, do we continue to see double-digit inflation, or would it ease out during the year? As you can see, a lot of it, the initial part of the inflation rise was driven by food, but in more recent times, both the non-food component has also gone up. And we can also see, I think, on the consumption side as well, I think we've seen a lot of monetary aggregate growth taking place as well, the M2B growth being quite high, but I think since the hike in August, it has eased slightly, but that has also contributed partially to the demand side of it as well. And this is where potentially monetary policy could ease the demand side constraints of inflation. So what would likely happen, I think in 2020, I think if you look at it from an annual average basis, we've historically been used to 4 to 6% growth in terms of inflation. We think that it could be on an annual average basis close to double-digit level, or if not above that. But at least in the first 6 to 7, 8 months of this year, double-digit inflation is something that we will need to price in or plan with. But if global commodity movements recover, some of the domestic currency fluctuations, some of those concerns eases, food supply becomes much stronger, I think we should be able to see inflation towards the end of the year reverting back to single-digit levels as well. In this backdrop, the third theme really plays out in terms of where do we see interest rates going. So if you look at domestic policy rates, we did see with the pandemic central bank easing along with a lot of other global central banks, and interest rates fell to record lows, and that sort of stimulated another part of the stimulation of the economy that took place. But since August, we've seen two hikes, one in August and one at the start of the year as well, which has pulled up interest rates, and we've seen a faster pickup in the lending rates compared to the deposit rates, and that and I think the deposit rates will also now pick up going forward as well. What has that meant in terms of credit growth? We can see that since the August hike, absolute growth or monthly change, the purple graph has slowed down somewhat. And I think with high interest rates, the credit cycles also might ease a little bit as well. But from a historical perspective, if you look at interest rates since in the last 2 decades, you can see pretty much these up and down cycles in the last 2 decades. And each cycle in the past has seen interest rates, the peak becoming much less. Earlier, we did see in 2008, we did see the prime lending rate above 20%. In 2012 adjustment, we did see close to 15%, 18 slightly under it. So the question will be, would the lending rate go much higher than these peaks in the past? And I think that will really depend on the number of more hikes that the central bank might put in, and also if a lot more of the pressure on the currency is borne by interest rates and the demand side to ease the economy as well. So that will really play its part, and we think there will be at least 1 to 2 more hikes during the year, which will push up inflation, which will push up interest rates further. 2021 was a good recovery year for exports. As mentioned, apparel, so many other exports did much better than expected. And we saw at least goods exports recording good figures in 2021. It remains to be seen whether this can be sustained, but global factors, I think, will play a bigger part in this aspect as well. And the recovery was very much broad-based, not only apparel, but tea, rubber, which crossed 1 billion threshold, and of course, a lot of agricultural products, which are also now picking up as well. However, while we did see a lot of expansion in exports, the import side of it also was much higher, especially compared to 22, which saw imports falling significantly. A lot of these are beyond sometimes Sri Lanka's control, items like fuel. Some of it relates to the export component, for example, the input that goes into apparel, or some of the other inputs that go into the different industries that we export with as well. But we also saw things like pharma, medical imports also picking up during the year as well. And of course, with the reopening of the economy, more construction taking place, we've seen much more investment goods also coming in. So really, if you look at from a value or volume index, yes, the volume has picked up, but not as much as 2019, when we saw the volume index close much higher than what it was in 2021. But it has been a lot to do also with the value, with a lot of these prices influenced by global factors as well. So we overall saw 4.5 billion increase in the import bill, a lot of it predominantly sometimes beyond the control of policymakers and even the private sector to some extent, because these are determined by global prices. But this has been one of the key fundamental drivers of our import bill as well. As a result of this and the widening trade deficit, the slowdown in remittances, we've really seen a significant expansion in the BOP, which we've not seen in the last few years, and that has caused some of the pressure, most of the pressure, I think. Well, with the rupee kind of at its current levels, we've really seen a significant slowdown in remittances. A lot of measures are being put to get remittances, at least on a monthly level, much higher, to get more departures going as well. But clearly, Sri Lanka seems to be an outlier in terms of a lot of the other countries which are in the region, which are seeing more remittances coming back as the economies recover and more migrant workers take place as well. The bright spot has been tourism in terms of its quicker than expected recovery. Already January and February, they seem to be doing quite better than expected, though of course not at the peaks that we've seen, say in 2019 or even the early part of 2020 as well. So this recovery really will be another crucial factor to see how Sri Lanka can also manage its payments and the dollar liquidity situation. So overall, we did see the rupee, at least within the central bank rates, around 7% depreciation. Some of the other rates in the informal markets are much higher, but it'll be interesting to see whether this rate will be held or whether we will see some level of a managed or a controlled depreciation to really reflect some of the market pressures, or will we continue to see it being held at these levels while interest rates and the other parts of the economy will take in the shocks. And this determinant will be on where reserves move. We did see reserves slide during 2021, a lot of it to refinance the debt that has come up. We've seen some level of inflows towards the end of 2021, swaps and some of the other arrangements, which has improved reserves, but it is at a very dangerous level in terms of import bill and also what we have in terms of refinancing the next 12 months, which is close to about 6.9 billion, comprising of different instruments: Sri Lanka development bonds, international sovereign bonds, multilateral debt, ISP. Some of those which are front-loaded in January in particular, where we saw 100 million sovereign bond repaid, and even these couple of months where we've seen a lot of SLDBs coming up for maturity. So this will be a very tight management, in particular in the lead up to the ISP payment in July, and what steps the government will take in this regard as well. Global point of view, a few slides just to recap. I think global growth expectations are getting much more muted compared to previous forecasts by both the World Bank and the IMF. So the recovery that we saw in 2021, there will be growth, but it'll be much at a slow pace in 2022 and even a slower pace in 2023 as well. In some of our key markets like the US and the European Union, a lot of these export markets have been part of this slowdown growth story as well. I think in terms of the cycles, as keynote speaker mentioned, we are in an upturn in terms of global commodity prices. We saw that in the global financial crisis, and that had a big impact on Sri Lanka's BOP, and we are seeing a similar trend here. And this in particular has had impacts on inflation, and going forward as well, we need to see whether this will return back to some level of normalcy, or will we continue to see commodities going much higher, particular oil, which is close to the $100 barrel mark as well, because those are key inputs to the BOP as well. So in terms of the next 6 to 12 months, we do see, of course, the pandemic will continue to be a factor in the backdrop, new variants and what it means. Those will have disruptive elements. The shipping and air logistics costs, if it does normalize, that will be great for Sri Lanka's trade purposes. But unless that does take place, there will be added pressure for Sri Lanka trade perspective. Right now, there's a lot of concern of what's going on with Russia and Ukraine, and a lot of the tensions that are happening there. That is an additional factor that needs to be kind of priced in and weighed in terms of where these commodities and inflation go down. And of course, trade risks that we often see each year, which have still not died down. So going back to the themes, I think growth pre-pandemic levels, really higher sustained level of inflation, really plan for higher interest rates. I think good to see how the previous cycles have been and how newer businesses have fared. The dollar liquidity situation, I think that will continue to persist, and then some of the difficulties that the private sector is facing might persist unless certain measures are taken. And of course, the global risk, though in 2020 was not, or 2021 wasn't too too concerning right now. It is given the impact on commodities and inflation. So with that, we are happy to launch the Outlook report, and let me thank my team for putting this together, and it's available for purchase on our website, and you can access it through the link which we will drop in the chat box. So with that, let me hand it over to CEO Manjula to manage the panel discussion.
Thanks very much to Shiran for that presentation, and also thanks a lot for all the work that has gone into the Outlook report, which we have just launched. So since we are a little behind time, let's move straight into the panel discussion, noting that we have close upon 120 participants on this webinar. So that's a good thing to note. And okay, let me start straight away with a question to Bingu Mal. So Bingu, a lot of economists and other experts seem to be of the view that the government must embark on a preemptive debt restructuring program in a systematic and methodical manner, right? In order to address this currency shortage, I mean, which is the #1 sort of, concern today to everybody, including those of us in the private sector. So can you elaborate on what this means, and how should the government get about in going forward this debt restructuring fund?
Yeah, Manjula, thanks for inviting me. Let me quickly recap. I think Shiran also touched a little bit on the macroeconomics. Very quickly, just to understand the backdrop, we have a larger fiscal deficit going into double digit, and we don't see that settling down this year. A lot of the countries have gone into double digit and slowly recovering, but Sri Lanka has some other challenges. The current account deficit is also widening, oil is rising, and apart from all of that, we have a FX crisis now when the reserves are low. So we have multiple challenges. Plus, we have basically restricted access to international markets. In a situation like that, countries have multiple options. The first thing a country would do is fiscal consolidation. Second thing would be debt postponement, or we call it soft and shallow debt restructuring. Third option would be a comprehensive debt restructuring. Now, on the fiscal consolidation, I think government has recently started, removing price caps and things like that, but far from where we want to be. In terms of soft restructuring, I think the work has started in our view, because we are now talking to non-Paris Club members like India and China and talking about postponing some of the payments. So that has started already. So the other leg is a non-Paris Club on the bilat side. Non-Paris Club members like Japan is a big component of it. I think we have to start the conversation. I think all this conversation started already in terms of at least postponing the debts with the Paris Club as well. So if you manage the bilats and some amount of multilats, that's one big component. I think that is critical. We cannot say that we're going to settle everything this year, because we have $6 billion of outflows. From next year also, we have $4 billion of foreign debts every year going into like 4 years. So it's very important that we flatten and come to some kind of a agreement, at least with the bilats and the multilats. And the second piece of this whole restructuring is the ISBs. Everybody is talking about why do we pay on the bonds and we should not pay on the bonds and things like that. I don't think we should ever default. That's my view. But in terms of restructuring of the ISBs, there are multiple options. It's very important to understand. So now I think we have about $2.5 billion of ISBs after settling some amount of dues. The most important thing is the legal implications around it. Do we have the collective action clauses properly drafted? I think we have, and there are different collective action clauses. We call them the CACs. Different types of CACs where you can work on clubbing series of ISBs, or there are different CACs you have to work on one particular ISBs. In our portfolio, I think if I'm not mistaken, we have certain CACs where you can club certain ISBs together, and there are certain CACs we have to work separately. Now, the long story short is you need a super majority, that is about 75% of the bondholders in terms of value, to agree on a restructuring, be it an interest haircut or a capital haircut or even a postponement, it's critical to have a 75% majority. So it's not an easy conversation. You need to bring, expertise in. You need to bring somebody like a Lazard as a consultant to bring in to, negotiate on the ISBs. The third restructuring is the domestic debts. Again, a very difficult component, because that will have a huge impact on the domestic financial sector, because all these domestic debts are basically held by some of the banks, as well as EPF. So haircuts on those will definitely, have huge MTM losses for the banks. So separate guidelines on those MTM losses will be critical in a scenario like that. More than anything, you need a clear assessment to see how it will impact the financial sector, because somewhat today, whatever it is, we are a double C country. Our financial sector is performing reasonably well, with a LI portfolio of like 5%. So we should not upset the apple cart. Very important to have the financial sector's ability. So those are the three things. Then in terms of framework, then especially when you're going into the ISBs, they can ask, have you done the multilats or the bilats first? So that will be always a question that ISB holders will ask. It's very important that you start with the multilats, multilats, then go into ISBs. And when you go to ISBs, it's critical that we have IMF as a not to, as an arranger, but as a facilitator to support this. Now, they will not do any consultancy work like a Lazard or any other investment bank, but having IMF on the side will be a huge benefit in terms of fiscal policy and the governance around it. So that's one important component. Some countries have also used IMF as a tool to negotiate with the bondholders, saying if you agree on a haircut, we'll bring IMF in. If no haircut, no IMF kind of thing. That also we have seen in some of the markets. Now, LATAM is a classic example of a debt restructuring. They've done the most amount of debt restructuring in the world. In the early 80s, 26 countries went into stress and did restructuring. Out of that, 16 countries or LATAM countries, Argentina we've seen multiple times. Jamaica is a somewhat reasonable example. So it is an option that the government can't exercise. But there are a couple of other elements. Like I said, the legal element is critical. The other thing is the financial sector buying. Other thing is the whole stakeholder buying. Also, moment you declare, now we say you get a consultants and you bring IMF in, then you agree on a restructuring, you announce that. Moment you announce a debt restructuring, you go into technical default. What does that mean? You go into a D rating as a country. So from that to until you come out, and then until you bring the flows in, there's a stressful period for a country, and some countries have taken longer time to recover during this period. I can recall in Argentina in 2001, IMF I think put $14 billion into the system. That was not enough. They put another $5 billion into the system by end of the year 2001. That was not enough. In 2002, January, Argentina came and said we cannot, pay the bonds. So it's very important to quantify the, projection. Look at the projection and quantify what we need in terms of reserves and settlement. The figure that we need to run the country for the next 6-7 years, and IMF will have to chip in, not with $1 billion. Definitely a couple of $1 billion. Plus, you need like a separate fund where multilaterals will come and park some amount of money after some kind of IMF support. So that is an option that we can exercise, but doesn't mean that's the only option. Debt restructuring is also like a drug in my view, or an emergency room I call it. Countries, LATAM countries go there all the time. They go there every 10 years, they come out again, go there. So because if you don't do reforms, if you don't build a sustainable economy, we will be sitting and having the same conversation in 10 years. So that's my take. So it's very important to do fiscal reforms. Of course, you should not front load the reforms, because front loaded reforms can, again, slow down the economy. We have seen that in the past. So sustainable reforms are critical on the fiscal side, and the growth policies, and having policies around market expanding FDIs and plans around improving reserves. FX inflows. So those are the plans that government will have to work on while working on some amount of restructuring. In our view, the bilateral restructuring has started already to a certain extent. Thank you.
Thanks, Bingu. I think that's very helpful to get an understanding of all the options around restructuring. And also you gave a good lead up to my next question, which I'm going to direct at Roshan. Roshan, now a lot of people tend to look at the fiscal deficit the country is grappling with as a separate issue from the balance of payment difficulties that we are currently experiencing, which is leading to the currency shortage. So can you, as an economist, help us to understand the connection between these two and why the government needs to focus on the budget deficit in reducing the budget deficit as well in order to address the forex issue in a sustainable manner. And also maybe you can touch on some of the reforms also that may be needed on the fiscal front, as Bingu also alluded to. So if you can touch on those aspects, that will be helpful.
Okay, thank you for inviting me first to participate in this discussion. Just to get to your question, I think to start from basically start from all these Econ 101 classes that we remember. We remember this national income identity, right? Where we all know, we all learned that the GDP is made up of consumption, both government and private, plus investment, again government and private, and our net exports, right? So C plus, I plus, NX, and net exports. And from that identity, we also know that the level of consumption, that is both private and government consumption in an economy, is what affects the level of savings in that economy, or our national savings. So if we have a lower level of consumption, that means we have higher savings, which leads to higher investment, and vice versa. So a higher level of consumption would mean lower level of savings and lower investment. So in a country, if a country's domestic savings, that is both the savings that it gets from its private sector and the government's savings, if that's not sufficient for all its investment needs, basically that gap between our domestic savings and our foreign savings, or our investment, has to be met through foreign savings. This gap that we're talking about is really what we refer to as this external current account deficit. It's a gap between our domestic savings and our national savings. So there's a very clear link between the savings, both of the private sector and the government, and this external current account deficit. So to take an example, so if the current account deficit in itself, it may not be a bad thing. Because, for instance, if that shortfall between our savings and our investments is due to the private savings, so private savings is less than investment, because in private sector wants to invest more, or is investing more. Basically, that shortfall in the private sector, the private savings, can be bridged used by foreign direct investment. So basically, attractive foreign direct investment, and that is exactly what happened in most of these Asian economies. And I think Kenneth De Silva, he alluded to that. How did those countries progress, and how did particularly China? That they had a huge buildup of foreign direct investment because they had a shortfall in their domestic savings, but they had this huge requirement for investment, which they bridged through this foreign direct investment. And consequently, they actually all ran current account surpluses because they had more foreign savings than even what was their requirement, really. So they had huge current account surpluses. And this is favorable for the economy because it's leading to increasing your productive capacity, which will increase your income in the future. And also it brings in know-how into the country. On the other hand, the experience in Sri Lanka has unfortunately been, from basically the post-independence period, is this deficit has really been a mirror image of the government's spending earnings deficit, because the government has continuously has run these deficits. And to finance these deficits, we have ended up having to borrow externally, and that's where we have actually had a problem, and now we're seeing the effects of that, right? So this is what is often referred to as the twin deficit problem. We have a deficit in the fiscal deficit, which leads to a deficit in the current account deficit. And this government saving is really has been the root cause of most of our macro instability, which has affected all sectors of the economy through the interest rate to the exchange rate. It has basically had an impact on all the monetary sector, on the real sector, etc. So a government may think it has continued to run deficits. So as long as lenders, both domestic and international, are willing to fund those deficits at a reasonable cost, you may think that you can, continue to spend more than you earn. But as you build up these deficits over time, it basically undermines confidence of lenders, right? And then you end up in a situation which we have has come to be, which I think Bingu will also refer to, is basically we have lost access to financial markets. And this has really highlighted the vulnerabilities in the economy. because we have been continuing to run these deficits. And as long as we were able to finance them, we kind of, managed somehow. But now we have come to a problem where we are unable to roll over these debts. So as a result, what has happened is we have had to use our foreign reserves. We have had to drastically cut down our imports, which has had a significant impact on all other sectors in the economy as well. Right? So the current situation we are facing is very different to what we have faced in the past. And I think Bingumal referred to some of the issues that we're facing. Basically, government debt is one of the highest in historic terms. We have debt service payments, which are, I think, even in other countries, it's one of the highest. We have fiscal deficits, which are higher than we have in the past. Foreign reserves, which are fast depleting. Our trade deficit, despite all the import controls, our trade deficit is still widened. And we have a deficit in the BOP, which is probably one of the largest on record. At the same time, we are facing issues on the monetary side because we have tried to give, interest rates are low. Now we have increased the interest rate. But to finance this deficit, we have also had to resort to domestic financing, and that has been through the central bank's financing. So monetary aggregates have increased, and so therefore we have also seen inflation. That is not the only reason, as I think Shiran pointed out. There are many reasons for inflation, but one of the things is definitely now is due to the increase in monetary aggregates. So this is the problem, but how do we address it? Right. So this problem did not occur overnight. Hence, it's not something that we can solve also overnight. But I would like to suggest a sort of three-pillar approach to address the situation that we're facing right now. So one is, I think, this Bingumal, I think, referred to a lot of these things. You have to address the macroeconomic imbalances. I mean, without doing that, we cannot even think about growth. We cannot think about going forward. We have to address the macroeconomic imbalances. And I think that is the huge issue. I think Bingumal, I think he gave a sort of good idea of everything that needs to be done. But apart from apart from the debt, I think the other one is we have to address the fiscal deficit going forward. And in a sense, when we are going for a debt restructuring, or if I even try to talk to our creditors and asking them to give us some time to pay, basically they'll turn around and say, what are you going to do in return, right? So you also got to take some pain in return. So I think we have to think about very carefully what are the areas that are going to have the biggest impact. So one thing I think we really need to look at is this is our tax, the tax revenue, because I think that was really the turning point for investors in terms of the investor sentiment, but that the tax changes that were made at the end of December 2019. That sent red flags to investors, financial markets, that basically Sri Lanka was going to have a huge problem in terms of its fiscal and repaying its debt. So I think for one reason is for investor sentiment. The other thing is we need to be able to create fiscal space. I think when we are faced with economic shocks, such as we were faced with the pandemic, to be able to even address them, to be able to support businesses and households through these shocks, we need to be able to create that fiscal space. And for that, government needs resources. And those resources come through tax revenue collection. So I think that is one thing that really needs to happen. I mean, if you just look at the numbers, we have lost something like 500 billion in terms of tax revenue in 2020. It's probably same or more in 2021. So there is a case for reversing some of those. So it's not a case of imposing new taxes or raising tax rates. It's more about broad basing the tax base, expanding the tax base, improving tax administration. I mean, just an example, if you look at the VAT, what happened to the VAT threshold, basically by increasing the threshold from 12 million rupees to 300 million rupees, we basically wiped out 70% of the taxpayers. In terms of income tax, we by increasing the personal income tax threshold from 500 or 600,000 to 3 million, we wiped out something like 30% of the taxpayers. So I mean, these are simple things that can be reversed and brought in just to improve tax collection. And I think that is vitally important. There are many other areas, public sector reform, state-owned enterprise reform, many other things, and we can talk about them later. But I think that's critical. But in addition to that, We also need the structural reforms for growth, because we can't ignore growth. And also we need to build buffers to create fiscal space to protect the vulnerable in society. But I'll stop there, and maybe we can take this up later in the discussion.
Thanks, Roshan. I think that was a very comprehensive response, and I think made it very clear the connectivity between the fiscal side and the external side. So can I now bring you on, Haja, and just get your view on, the currency shortage that we are facing today is hurting business in multiple ways. So as the head of a multinational company, which has significant presence in both trading and manufacturing operations, can you elaborate on how this prevailing situation impacts on trade and industry? To get a practical view from the ground as to how business is having to deal with these pressures. But at the same time, looking forward, I would also like to get your view on how this higher inflationary expectation for 2022 would have an impact on consumption patterns that you expect to evolve going forward. So I would like to hear your views on both those aspects, Haja.
Thank you, Manjula, and I just would like to thank Dr. Kenneth Bingu about their intervention. I will not repeat what they have said. So the question addressed to me was about, how the shortage of FX is impacting our business. And I will need to speak about, the very, very basic of doing business, which is ensuring that there is an ease of doing business. By ease of doing business, I mean the ease of getting raw material, the ease of manufacturing this raw material and putting those on the shelves for our consumers to consume. As we see Sri Lanka unfolding, actually the demand is increasing. Thanks to vaccination, thanks to the country opening up, consumers need our product. The challenge we as a multinational have, and many other sister companies have the same, is to have that supply of raw material that make us produce. And that supply of raw material is, there is an issue as we speak because we are not able to honor the payments, which, Sri Lanka is an island. We do not have mines, we don't have industries like petrochemicals, etc. So we are bound to be importing some raw material like crude oil, etc. So that is impacting us, impacting everyone. And we're working a lot with the banks. We're working with our suppliers. We're working also with our parent company. I think Dr. Kenneth has mentioned that. Unilever has the possibility through its wide presence in many countries that are seeing ups and downs, because we know that Sri Lanka is not on its own in this economic dilemma. It has been seen many, many cases in Latam, in Turkey, in Egypt. So we are able through this dialogue to continue have a parental help. But a parental help can only happen in an investor-friendly environment. And now let me come to what is an investor-friendly environment. So something which Dr. Kenneth has spoken about, and it's impacting us as well, is the inability to also invest in capital expenditure. Capital is the heart pulse of how you bring any country forward, and you said it very well, Dr. Kenneth, because that's how you build technology, this is how you bring machinery, you bring new skills, you bring new talent, and therefore you make the economy move forward. And for us to commit to capital, just for an example, we spend about 4 million euros on capital every year. But this year has been a challenge because we are not able to buy machineries at the dollars, which are scarce to be found. And another way to look at it is I just want to turn a little bit this conversation to be on the positive side of things. So what can we do to make Sri Lanka the business that has made so many investors commit to it? The reality is we have had our good patch of many FDI coming in. So therefore we should still be amongst the preferred people. So for me, it comes to consultation with private sector. I think that's a very important way forward for us to make sure that, the large players in the economy, be it exporters, be it importers, be it banking sectors, that are put around the table and discuss together how the economy is going to unfold, because uncertainty is the worst way to lead any business, at least when we know we're able to prepare for it. So that's number one. Number two is to quickly move from the short-term decision-making to a long-term decision-making, including commitments from investors, commitments from the private sector to continue fuel the business, to continue secure salaries, to continue build the community. So that's, I think, is for me the dialogue and the long-term strategy. Lastly, you know, I am really happy that tourism is picking up, but that too needs a long-term strategy, because otherwise it will have a yo-yo impact. Number two, we speak about apparel, we speak about tea, but how about export for all of us? So last year we started exporting, and from nothing, now I get a €1 million export a month. However, Pakistan and Bangladesh are having 3x that, 4x that. Firstly, our products in Sri Lanka have the highest quality standards, but the way our duty structure is done around export could also change to be more of an exporter friendly outside the apparel sector, or in addition to, if I may say, apparel, etc. So I think summary to the first question, because I know we're late and I also have a hard stop, is it is tough. It is a daily game, and what makes it tough is really the uncertainty. I think what we would welcome as a private sector is to have a dialogue, to have a long-term view, and have a commitment both ways as to how we can create an investor-friendly environment. Now, coming to the second section of your question, Manjula, is inflation. Look, firstly, inflation is everywhere, from the US to the UK to Sri Lanka. In Sri Lanka, this has been compounded by the currency, by the fact that Sri Lanka has to rely either on sea or on air to get any goods, because we are an island. So we have a much higher inflation looming. And I think that will be something which we need to accept and work around. And when I say work around, what does it mean for the consumer? I think Bingumal has touched that if we go to open the currency, for example, there will be a huge implication, and we don't know for how long, on consumerism, poverty, unemployment, GDP contraction. That will really go south. So I think it's our duty to make sure that the affordability of our products continues to remain paramount in this inflation. We will have to think it through with savings, cutting the frills. So all these lines of the P&L are going to go through an intense scrutiny, because otherwise we will just actually make the inflation worse. But I think that will be better in 2023. So this year we know that the first half is going to be the toughest. So we will tighten the ropes and move forward with that. And I'll leave at that, Dr. Manjula, so that the rest of the participants can add.
Thanks, Haja. Thanks for covering both aspects of my question very well, and also referring to some other important aspects as well. In fact, you sort of led up very well to my next question, which I'm going to put to Vinod, because that's on the importance of the export sector, which you also touched on. Because the government, as well as those who are more optimistic about Sri Lanka's ability to come out of this crisis strongly, tend to place a lot of reliance on the export sector. So as the representative of the apparel industry, I mean, it's by far the largest export sector in the country. To what extent do you think export earnings can grow, I mean, within a sort of a medium term to help narrow the trade deficit that all of us are concerned about, and also at the same time, how fast do you think we can reduce our dependence on imported inputs so that gradually we start raising the value addition specifically from the apparel sector, with a lot of attention recently given to the promotion of textile manufacturing in the country. So I'd love to hear your views on both these aspects, Vinod.
Thank you, Manjula. Thank you, Dr. Kenneth, Bingu, everyone else on the Hajia. Thank you all. Really appreciate all the input and knowledge sharing you've given this afternoon. Manjula, thank you for your question. So let me just give a brief kind of market overview right now. The positives are that there are no more lockdowns, hopefully, in our export markets, and restocking is taking place. our customers are also realizing post-COVID that they're going to spread their risks. So that's to the benefit of Sri Lanka. So, but rather than putting a lot of product in, say, Bangladesh or Vietnam, that they're spreading it out through different countries. So these are all positives for Sri Lanka. And we've come out, obviously, with the vaccines and the boosters, which are really, so we hope there'll be no more disruptions in Sri Lanka. And therefore, we should comfortably reach and go over the 2021 figures in 2022. To your question on the medium term, Manjula, we should focus on, as Dr. Kenneth said, about the region. So for me, the FTAs with China and India will really create new markets that are closer to home and going to really grow, our exports to these countries, which are not large relative to the rest of our exports. GSP plus, the renewal of that is very important to see that beyond 2023. Our trade with the UK, with them leaving Europe, is also very important, and that's extended. We also, Sri Lanka is not the cheapest market in the world, but our focus on sustainability and recycled materials is very important. So, we are looking at more investment in that and looking at the zero carbon emission factories and things like that. So if we focus the brands on that, I think that would also give us additional growth and value addition. On your question on the fabric mills, Manjula, as Dr. Kenneth mentioned, it's a 2 to 3 year horizon. Currently the mills that we currently have only give us 20%, less than 20% of our requirements as an industry. So I know the government is talking about Erevalur and getting people into those zones. We are actively canvassing as well with our Chinese and Vietnamese counterparts. But I also look at the current mills that we have. And one point I want to make is that we need enhancement there as well. And that will require most of these mills are in zones. And that will require the zones themselves to upgrade their treatment plants and effluent plants so that we can enhance those capacities. I hope that briefly, I know we're short of time, Manjula, but I hope that briefly answers your two questions, and happy to take any clarifications if needed. Thank you.
Thanks, Vinod. Thanks, certainly. I mean, and it's very, very interesting, the point you brought about, the existing mills and how we need to sort of develop them as well to bridge the gap between the demand for textile, and what is currently available through local supply. And also, I think that indication that it will take about 3 years for this new output to come out of the proposed textile zones. I think that's also something we need to factor in when we make projections, I suppose. So that's very useful insights, which I think we need to factor in when we talk about the expected earnings exports, particularly apparel, because I mean, there is so much we can get, but then it takes time. I think one has to factor in the time.
I think Manjula, we can comfortably say, 5% over 2021 figures, but beyond that, again, it'll take some time, Manjula.
Sure. Thanks a lot for that insight. Very helpful. Yes, we are running a little bit out of time, but I'd like to take at least 1 or 2 audience questions to do justice to the 100+ audience we are having here today. Yes, I can see one question that has come in. Let me put this to Roshan because it's a bit on the economic side. The question is, we are discussing about increasing revenue and we are not looking at managing these resources. So he comments that waste is more than 25%. Do you agree with this statement? And either whether you agree or not, but do you feel there is something that needs to be done on that front?
Thank you, Manjula. I think in terms of public expenditure, if you compare Sri Lanka's public expenditure with even our regional countries, in terms of the absolute number or as a percentage of GDP, it's actually fairly low. But I agree that within public expenditure, yes, there is definitely room for a lot of restructuring or reform. Because we know that a large amount of the public expenditure goes on salaries. We have a huge public sector. We have a lot of it also going into defense. And these are issues that really need to be dealt with, because are these actually having a productive impact on the economy? That is one. The other one is, we also know that there is a lot of subsidizing or subsidizing that is going on, particularly with regard to the state-owned enterprises. And we know the inefficiencies within these enterprises. So certainly there are areas within the public sector which need to be addressed. But I would say that the overall number, you can't do really very much. So that's why why you need to really increase your revenue, or you really need to increase your tax collection. But certainly, I would say that you have to keep control over the sort of the bottom line, which is like your fiscal deficit. And there we have measures. We have these fiscal rules. We have the Fiscal Monitoring Fiscal Management Act, but it hasn't really been. It doesn't have a lot of teeth. We haven't seen it being implemented. It is continuously the deficits and the debt has continuously exceeded the limits that have been given within the act. That is one, and then also the central bank's ability to finance the deficit. I think there are certain things that need to be done to ensure that there's better control over public finances. But it may not necessarily be in terms of the overall number. So yeah, that's what I'll say at the moment.
Thanks, Roshan. I would also like to add a little bit to that answer, because I have also studied this and found that actually although we talk a lot about the wastage, when we look at our expenditure, government expenditure as a percentage of GDP, it's not really that high compared to a lot of other countries, where our problem is mostly in revenue. We are far behind a lot of other countries. So, therefore, the revenue issue is the most important. But of course, one should address the expenditure side as well, I mean, to the best extent possible. But in terms of what you can generate, there's far more potential on the revenue side when you look at, in comparison with other countries. There's one more question, so I think we will take this as the last question since we are really overrunning time. That is, I think we'll refer that to Bingu. How can Sri Lankan banks help in this situation?
Thanks, Manjula. We are helping at the moment. It's a very tedious challenge. I think when you say this situation, are we talking about the debt challenge or the FX challenge, Manjula? Or both?
I'm just reading the question that's there,
right,
but I
right.
believe it's on the
I think the FX. Yeah, on the FX front, all the banks got some kind of a governance committee where we sit and discuss what transaction to prioritize. We have taken, a lot of the banks have taken decision not to prioritize certain areas, and you drop those areas and focus on pharma, food, energy, and things. So that's the best we can do as a community. But as part of SLBA, myself and the board had been working very closely with Central Bank to understand some of the reform work that they're doing, as well as some of the plans that they have on the debt, sustainability. So that's where it is right now. As a banking community, as an industry, we are very stable. Though the country is downgraded, our NPAs are still hovering around 5%. It has actually settled down now from the previous levels. But I would advise you all to work with your banks very closely and give them some time. When you have a transaction that you don't expect 24 hours delivery on, especially if it's like a large transaction. Anything above $100,000 is a large transaction nowadays. So give some time and have your forecast ready and plan your imports properly. Also, do not, do stockpiling. We've seen some of the customers have ordered goods up to December. So that's very unhealthy right now. The import bill have gone to $20 billion as of last year. And December was the highest. I hear January number is also not great. So that will add to the problem, and we will have to go into very serious reforms or drastic measures in the next 3 to 4 months if we not slow down on the imports.
Thanks for those words of advice, Bingu. I think it's very relevant what you said about, particularly the tendency to stockpile. I think we should be cautious about that, because it's not going to help anyone. Since we need to really get a grip on this currency issue. So I think we have taken almost 15 minutes more than our scheduled time. So let's close with this, and let me thank Dr. Kenneth De Silva for his keynote speech. I'm not sure whether he's still there on the call, but thank you very much to you. And thanks a lot also to our panel, Bingu, Haja, Roshan, and Vinod, who covered a lot and also spoke fast. Thanks a lot because you helped to catch up as well while covering a lot of ground. And thank you very much also to Shiran and the team from the EIU for all the hard work put into the report as well as in organizing this webinar. So thank you very much, and let's meet again at a similar forum. Thank you very much.